Can earnings save the markets from the doldrums? Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget you can click Show More for additional information, links to articles from today's video, and if you're looking for a different opinion not seen on Wall Street, please do consider subscribing. First up, numbers, week ending 4/13, a little bit better, not great, a little bit better, at least NASDAQ and smalls are in the green. So, now let's go to the big charts. First up, year-to-date, been showing this for a while. Couple things here. First off, Friday, we really sold into the close there, but the VIX, which is at the bottom, volatility index, actually went down. Very surprising. That might be a show of things to come as we head into this week. At the top, relative strength. How are you doing with the markets? Can't get above 50. Been stuck there, ended just below that. If we can break above 50 and sustain, that will be good for the markets. Now, the middle of the chart, lots going on here. So number one, resistance, 20-day moving average. I'll have Michelle highlight that in blue. We've hit it 5 times and failed. Now, we got above it on Friday and locked right on it to close out. So we've had a lot of resistance, can't get above it. Now what was once resistance looks to be support. The problem is our next level, which is your 50 and 100 day moving average, is going to create big time resistance. So until we get above that, I'm not going to be deploying any more cash, until we see that, some more strength in the market, because again, we continue to go sideways. The other thing on the chart here, we already have crossed over 20 on 50. Now the 50's crossed the 100 day, just barely, but something we have to consider. So right now, our short-term signals have gone from negative to neutral. See what happens this week. Hopefully we'll have an opportunity to deploy some more cash. Next up, new chart. One of our clients has asked for something new. Here you go, the Bollinger Bands. Holy moly, what is that? You can click below, how about that? Click below for additional information. But basically, you have a band, a range, 20-day and 2 times upper or lower. And as you see, when we're in that bullish trend line, if you're in the upper end, very bullish. And if it's tight, then if you get a wider range and it's below, that is not bullish. So right now, I have a zoom in there. If we can get above the middle range and sustain, maybe we can, in fact, finally start moving to the upside. But earnings, which we'll talk about, is going to let us know that. So, weekly chart here, yes, that bullish trend is still intact, but below, we've had 2 negative crossovers. So our midterm signals are negative at this point. Monthly, long-term views, we've hit our all-time highs. 2 months with lower highs, not bullish. And right now, we'll see. We still have quite some time here to go. Couple more weeks to determine, but based on this view, long-term view is positive. Together, as you can see, fairly mixed. Short-term neutral, negative midterm, and positive. So sometimes when I look at the markets, you want to take away all the price, all the noise, and just put in moving averages. That allows you to really see the trends of the market. And you can see I've highlighted some good points here, but obviously at the top is our highs, and we've had a lot of breakdown. This is a 20, 30, 40, 50, 100, 200-day moving average, and as you can see, the trend is definitely to the downside. We will continue to watch that. Next up, market breadth. Talk about this on a weekly basis. Did improve. These are companies above or below the 200-day moving average, above 60% bullish, below 40 is bearish. So we had a lot of improvement last week, as you can see. Most of these are in the 50s, so that is a good sign. Let's see what happens this week. So a shorter term view is going to be your 50-day. When you look at the 50-day, yes, we do have more companies above finally, so I have them all in green, but all meandering around the 40% range, except smalls at the bottom. Next up, international. Just real quick, want to show this. Here are the numbers, not particularly great. Here's a chart from Hedgeye. Last week, I'll show you where to get that. Great follow on Twitter. But 72% of global manufacturing is slowing. 89% global PMI slowing. 89% composite of PMI. 19 countries are slowing. So really, again, reaffirming that disconnect between U.S. and international markets. Let's go to the sectors. So here we have the top 5 sectors that are part of the S&P, tech being the largest at 25%. So you have 3 of 5 still in negative territory. So again, not really a bullish sign when you see them all at that level. Next up on my radar. So last week, I had been talking about oil, and I have been, you ready? Wrong. Unfortunately, we sold out of oil heading into this quarter. Various reasons, trends weren't there, worried about the dollar. It's gone the other direction. Here's oil and gas Titan. So 30 of the largest oil and gas companies. And yeah, it looks pretty good. It's come out of a base. It's working its way back up. That's one way you can get into the market. The other way, this looks great. We broke out to new highs on the price of oil. So that's another way that you can look at it. So going to start looking again. If I do deploy cash this week, that'll be one of the sectors. The next one is the banks. I think the banks got a really bad hit on Friday. Great earnings, but there was an article here that came out that said, here's why bank stocks are getting hit even after earnings beat the street. Take a look at that below, but yeah, I mean, it is interesting to see great earnings and fail on the market there. So that's not a great sign, to say the least. We had a lot of reverse candles on some of the big names there. So a little concerned, but obviously as interest rates go up, banks are still going to be a good place to go. This might be one of those sectors, I will add. Treasuries, spreads, 10-year minus 2-year, ugly. Look at this, 0.45. The lowest we've seen in quite some time. Not a good sign, and the reason we're having that, look at the 2-year at the bottom in blue, really rising on its way up. So that's one of the reasons. And again, when I look at treasuries, 10s minus 2s, here's a long-term view to the back in the late 70s, and each time the top of the chart is your 10s minus 2s. At the bottom is the S&P. The red shade there are recessions, and it's generally a leading indicator. So you can see it each time treasuries went down, it brought us eventually to a recession. So concerned about that. The next thing I've not talked about a lot is the LIBOR. LIBOR really comes to what our borrowing costs are. Here's a chart from Charlie Bolello on Twitter, another great follower. When you look at him, he shows here how much the LIBOR is raised. And this affects all of our borrowing costs. So loans, derivative, government debt, corporate debt, mortgages. Really, really surging here from a low up to where we ended on Friday. So very concerned about that as well. So what keeps me up at night? Well, not a lot. Really trusting our process. But here's a chart that shows car registrations really declining again. When you see them decline, it's also a leading indicator into recessions. Next, GDP started the quarter with forecast of 5.5%. Our range is now 1.5 to 3. Not a good sign. Where's all the growth? Next, earnings. Starting today. Going to have a ton of earnings this week. Are we going to see what happened with the banks? Or is earnings finally going to move us higher? Now, the reality is, if you go back a few years, here's the S&P. I overlaid GAAP earnings, generally accepted accounting principles, okay? Yes, we've gone up, but only 3.7%. That's what you see at the bottom, earnings growth, while the S&P was up 29%. Big disconnect. We're looking for an 18% surge in earnings. High expectations. If we don't hit those, that's going to be an issue. Wrapping things up, fear and greed. This week, 23, up from 9. Again, indicators, short term, neutral. Midterm is negative, long-term positive, so very mixed, which is why we still have more cash than normal, waiting to see if we get a direction on this market, and we will find out this week, I believe, because of all the earnings coming out. As always, thank you so much for watching. This is Michael Loftus for Wealth and Wisdom TV.